But the steak was beautiful. Not sure about the budget though.
And I think that's a really good analogy in terms of today, whether or not who's going to get the chunk of the pie right now is looks like there's going to be quite a lot of money that's going to be raised through increasing taxes, Vinny.
Yeah, I mean that's one way to do it if you're the government. But so yeah, I mean, in all seriousness, I think these are some of the biggest changes we've seen. I mean, I might say since I've been in accounting, and you might think that that's not been too long, but it has been about 17 or 18 years, and changes so significant like this are pretty crazy, or at least multiple changes like this all at once. I mean, we've seen some pretty large changes. Even I remember when you could put $1 million in a single year as a concessional contribution. That was back in I think the late 2000s. But yeah, these are mind blowing, to be honest. And yeah, I sort of feel like we're a bit of the bearer of bad news in some aspects here. But I guess if we push past those initial stages of grief, if we will, then I think we've got to be practical about this, make the most of what we've got, and thank goodness it's not everything's effective immediately. That's the big news, and I think maybe the first thing we might start off with, it's not immediate, it's not law yet. Hopefully there's a bit of pushback that waters down the initial announcements, but I'm not going to hold on to that. And then yeah, we'll see where it goes, even medium to long term.
Yeah.
Hmm.
Yeah, and I think it's a good summary of what we can try to do today is try to react to the situation and see what's in our control itself. And definitely, this budget is proving to be a painful one for investors and business owners alike. Again, the time to get used to that will be in this next 12 to 14 months. There is some transitional period that's introduced. Cool.
That's it. Just while you were mentioning that, Riz, I've just launched the first poll, which is who are you? Tell me all about you. No, the options are you a business owner, or are you an investor with properties? Are you both? Or neither, and you're just here to learn a few things about what's changed in the budget that was released last night. So what I'm seeing is if we add together the business owner and the both, we're looking at about 80% of the people who are here are business owners, and about 57% own property. So that's huge percent. So again, the focus or the lens we're looking through is business owners and obviously investors as well. That's sort of the types of clients that we look after here at Inspire. So 80% of you, there's 7% are neither. They're here to just learn. So that means that 93% of you are in the right spot. And for those who are here to learn, I hope this meets your needs for whatever you're looking to take away from today. Cool. Well, a little bit of background to me. So I am recognising quite a few faces here, which is pretty cool to see. So lots of existing clients, some friends of Inspire, but lots of people I don't recognise. So I'll do just a brief intro for myself, and then we'll do Riz as well. So my name's Ben Walker. I started Inspire over 13 years ago now, almost 13 and a half, back in 2013. Since then I've become an award-winning chartered accountant, 18 years of accounting experience, and written a few books along the way as well. And there's a photo of our beautiful family, and I think it might be even missing baby Vera, number 4, who is about to turn 2. My goodness, which is pretty cool. And Riz, would you like to give us a brief introduction to you?
As for those of you who don't know me, my name's Riz, and I've been here for will be 10 years now with Inspire. So yeah, been a long ride and seen some changes along the way, but definitely this being one of the biggest change we've seen in the time that I've been here with tax law changes. Now, I am a family man of that's my beautiful kids there, Elias and August, and my wife as well. So we are also in the same boat of investors slash business owners. So I do apply some of these changes to my own situation, and I think that's what gives me a bit of a kind of empathy and perspective on today's the budget changes last night is how is this going to fundamentally impact everyday Australians who are just trying to get ahead, right? So I think of those kids and what the future might look like for them, and how we're going to grow our wealth as a family from here on. So do excuse me if I do get a little bit heated in some of these exchanges today, but it is a very personal matter when we talk about our personal wealth, right? Especially when we talk about the legacy for our kids. So that's a little bit about me, and we'll get started with the webinar today. If you don't know us, we're from Inspire Accountants. We're based in Brisbane, but we've got clients all over Australia. But we just want to, we've kind of said this already at the start, is just before we start, don't panic. None of this is law yet, or don't panic, react at least. The government has announced these changes. Some draft exposure legislation has been released. There's consultation periods, draft bills, parliament still to come. So there's still a lot of work to go through before everything kind of lands. And obviously, once it lands as well, the government bodies like the ATO, and even state governments as well, they're going to have to react to some of this budget announcements to see how they can follow suit as well, or maybe even help with the situation. So for instance, the trust minimum tax doesn't start for 26 months. So bring that in months. Hope everyone kind of feels that. The CGT regime change doesn't start for about 14 months. So got over a year to react or plan towards that as well. So a bit of runway exists for every fact pattern. We're trying to plan, and there might be some restructures that we want to do in that window. There will be some of the central theme that we're going to be talking about is looking at your investment structures and your business structures as well. Cool.
Alrighty, so what we're not going to do is run through every single budget change, because that is not really that helpful. So you might have seen some changes to, I just had a quick look on Mr. Albanese's Facebook. I saw things like PBS and access to urgent care clinics and things like that. We're not going to go into much around, obviously, that fringe. Well, to us it's fringe because it's not our focus here at Inspire, but it's more like, how is this going to actually impact clients? And this slide sums up a handful of things which we'll cover in a bit more detail. So the first one is a minimum tax on discretionary trusts profit, which kicks in a few financial years' time. So that's from 1 July 2028. And again, what I like about this is it's not, so what I like about it, it is a shock to say something like that, and I almost in a way can't believe I'm saying that, given that's not how trusts have operated since I've ever knew about them. But what I do like is that we've got a few years to work out what the plan is. So the current financial year, we've got 2027, and we've even got the full 2028 financial year to potentially do something about it if it makes sense in our own circumstances. The second one, and this was a bit of a leaked thing that you might have seen over the past week or two, is the capital gains tax discount. That's the general discount that was available to individuals or trusts for holding an asset more than 12 months. That's now gone from 1 July 2027. So there's pretty in-depth rules around that. The good news is for existing asset holders and your gains made to date, or even until that 1 July date, we've got access to that general discount. What it does mean, though, is it means for asset sales after that point, particularly where you own them before that point, is the calculation around your capital gain and your capital gains tax is actually going to be quite interesting. And I also, what this slide doesn't say either is, regardless of your, let's say, your individual tax rate or your marginal rates, there is a minimum 30% on capital gains, which again just blows my mind. We how we go from a marginal tax rate system as well, but no, all of a sudden it's capital gains, so we're going to tax that in its own way. Almost like a flat rate of tax. So next one, the last one there is negative gearing for new purchases of established residential rental property. We're no longer going to be able to negatively gear. To me, I don't feel like that's much of a significant thing anyway. A few years ago, the depreciation rules were changed for existing properties. There's two types of depreciation that you can get with rental properties. One of those was actually abolished for existing rentals a few years ago, and then for new ones we've been able to get both sections of that deduction happening since then. And so to me, I don't even know how much this is going to play out or impact the economy. Um, but the rules are if you buy an existing rental, you need to silo any negative gearing until, let's say, a future sale, or until that property becomes tax positive, or makes a profit each year. So, wowzers, there is a lot. Also, what the government have also said down the bottom here, which again is sort of some form of trying to give us some relief. I'll see if I can get my pen. Here we go. So this bit here, they've given us a 3-year rollover window. So it starts from 1 July next year, which is sort of the 2028 financial year, through to 30 June 2030. Now, Riz and I were having a chat or catch up this morning about like strategies, and we'll get to some of those as we go. But it doesn't mean we just sit here and wait for that 1st July 2027. Some clients, you might have some changes to make in that window, but some clients might actually make sense to change your structure beforehand under the current rules, where, for instance, we have access to the 50% CGT discount rather than wait till we lose it. So anyway, every situation is going to be different. We'll say that up front. And again, well, I say that's from what we know now, not legislated. And yeah, who knows? We might get a little bit watered down, but I'd be silly to hold my breath. Whee.
What's important for us is to kind of give a bit of a visual timeline for everyone to see, because there's flying dates everywhere and changes coming across in the next 12 to 24 months. So let's start with the beginning here. At 7:30 p.m. last night, negative gearing, that's the grandfathering line. Essentially, negative gearing is starts at that point where previously owned properties, you can still negatively gear that. And then from 1 July 2026, IAWO stands for Instant Asset Write-Off. That's one of the changes that's going to be permanent from now on. So the reason why that's there is, if you don't know, the 20K, it was in the air. We don't know whether it was going to be dropped down to $1,000, where you can write off any asset purchases below $1,000 within the financial year. That seems to be staying on. One small win amongst many changes that aren't too good. And then Div 296 starts from 1 July 2026 as well. So this was announced earlier in the financial year, but that's related to self-managed super funds, where you have a balance of $3 million and more. The tax rates on those returns above $3 million goes up to 30% instead of 15%. And also from 1 July 2026, Payday Super starts as well. So business owners out there, make sure we get ready for paying Super at the same time that we pay our pay runs, make our payroll payments as well. And that's going to come through on the 1st of July. And that's something we've been talking about as well in this during this financial year to get ready for.
Now, just mention. Oh, sorry, just jumping in there. That's not a budget change necessarily, but that's another significant change for people who employ. From July. So if you haven't got your Payday Super ready or sorted now, you're not aware of what it is, please make sure, because that kicks in literally in just over a month.
Yeah, we actually did a different webinar a few months back, just specifically on about that. Now, let's fast forward, about 12 months later, or that 14 months later from now, July 2027, this is where the most important date comes in. The CGT regime changes, we'll go through those details. Negative gearing is essentially fully abolished for anything that's not new builds. So you can't negative gear any more established properties at that point. And then we start having this trusted company rollover window opens. Now, that last dot point is more related to what's going to come up in the next 12 months, which is the 30% trust distribution minimum tax start. So there's this window that we're going to foresee a lot of restructure happening, especially with business owners that do have trust that own assets in them, especially businesses that we can look at moving that to a company. Again, we'll go through some of those strategies today. And then that rollover window closes on the 30th of June 2030. So we've got about 3 years worth of time to get our whole house in order to make sure we don't get hit by that 30% trust tax where possible.
And what a nice lead in. Alrighty. So what is a 30% trust minimum trust tax? It basically says for every dollar of profit that a trust makes, it's the trustee is taxed, not the beneficiaries, is how it currently is. The trustee pays 30% tax on its income, and that's a non-refundable tax offset. So what that means is in the you like franking credits. If you received franking credits in an individual name and your credits exceeded your the tax that you would otherwise pay, you'd actually get a refund of that. How this works is that the trustee gets assessed at 30%, and even if you pay 10 or 20% in your own name, you don't get the balance of the difference back. So again, it's a very strange way to operate it, where you've got a company structure that you do get the franking credit back currently, and we've got our thoughts on why they might have structured it like this, which we might share as we go. The other huge eye opener is that if you pay a distribution from a trust to a company, sorry, yeah, a corporate beneficiaries, bucket companies, they don't even get this 30% credit, which is unbelievable. They get taxed again at their 25 or 30% tax rate in the company. Um, like I don't know, reason I just feel like, was that real? We just have no words. The other
I
thing,
hope we're getting it wrong, but it's so clear. It says that non-refundable for no credit for corporate beneficiaries, which is wild.
absolutely, absolutely, it is nuts. Even this one as well, existing testamentary trusts. So if you died before the 12th of May, as in before the budget was released, and you had a testamentary trust in your will, you're okay. If you die after, and your testamentary trust is essentially established afterwards, then from this 1 July date, instead of what would ordinarily happen with the testamentary trust, is it pays its profit to the beneficiaries, and even children under 18 gets taxed at adults. There was some great tax benefits of testamentary trusts. Now that's all out the window as well. I haven't had a good amount of time to go through all the detail there, but I do understand that if it's a fixed testamentary trust, you don't have to have this 30% minimum tax. So what this also means is that anyone with estate planning, which is all of us, you may need to reconsider how your testamentary trusts are set up if you've got them, if you want them as part of your estate. Again, just another unforeseen weird way. And I also go like, the government. There's two things I think this addresses, but it's not called it. The first one is a few years ago they wanted to get rid of refundable franking credits. Well, if your franking credits flow through a trust, now they're not refundable, is our understanding and our read of this. So they've essentially achieved that outcome. The second one is death taxes. There's big pushback every time they talk about that. We've already got some form of death tax, which is done through super. There's two different components of super, and if you distribute your super after you die to non-financial dependents, you pay 17.5% on a certain portion of your super balance. So essentially, it is a death tax already. But this testamentary trust outcome, same sort of thing. It's a way of getting an effective death tax. Cool. Maybe I'll get back to facts and jump off my rant horse. But
Gonna be a bit of that today.
oh yeah, well,
Yeah,
anyway,
yeah,
so
yeah.
so we've got a worked example here of 300 grand distributed to four adults with no other income. So pre this rule, we're able to distribute 300K, so 75 grand each for each of those adults, which looks at about a 17.7% effective rate of tax. Well, in that instance, that's doubling now to 90K because we just pay a 30% flat tax. And even in the individual name, because the individuals are otherwise taxed at 17.7%, they're not going to get the difference back. It's non-refundable. So the additional tax is a 70% increase on the tax bill. It's huge. It's huge. Welcome to the budget.
Mm,
Uh,
yeah. Oh, sorry. Do you want to do
yeah.
that one? Yeah.
No, I was fixing my camera. It was following me around.
Yeah, so when we talk about trust, usually also we combine the strategy of bucket companies in there, or the idea of a corporate beneficiary. So in the normal strategy of having a trust making profit, it distributes that to a corporate beneficiary. There is a kind of question around whether or not this strategy works anymore. So if you see those two boxes, through to June 2028, so 2 financial years from now, the current way that we're doing it with bucket companies, where you can use it as a bit of a catch-all bucket company that distributes excess profits for your family group for those 3 financial years, including now, and you still get taxed 25% in that company, and then franking credits can flow through as well. Now, from 1st of July 2028, that strategy is a little bit broken. The reason for that is the 30% trustee tax, because when you distribute any profits, sorry, the trustee gets taxed first at 30%. If you were to distribute those profits to a bucket company, what we're reading right now is that that corporate beneficiary gets no credit for that 30%. Now, to put it in another example, if you had 100 grand in a trust, it gets taxed at 30%, let's say. What happens is you have a 70 grand after tax cash that's available. If you distribute that 70 grand to a bucket company, it doesn't get a credit for the 30% it already paid. It gets taxed again. That 70% gets taxed again in that company, whether that's 30% corporate tax rate or 25%. Now, that's bonkers to us, which means that if you have money flowing through a trust, it doesn't make sense to send to a bucket company anymore post 1 July 2028. So this strategy becomes a bit broken, which means that this is, if we take enough of a step back, what they're trying to do is income from businesses or investments probably is taxed at 30%. At minimum, because even if it flows through a company, if it flows through an individual, but the difference here, if it flows through a company, it's more than 30%, because that 70 grand that I mentioned gets taxed again in the company's hand. So it just doesn't make sense. I hope there's something that comes through that makes that all go away in the details that come through in the months coming. But from the initial reading here, corporate beneficiaries is dead. We're not going to be able to use that post 1 July 2028. So the sequence that we're seeing right now is, if all this is correct, is FY26, FY27, which is this financial year about to end, and next financial year. Use the bucket company, distribution is normal. FY28 is the last year that we can use that before we stop distributing anything to the bucket company. Now, in that time, of course, what we want to try to do is either extract as much as we can from balances in the company, in the bucket company, look at restructuring so that there's another, which we'll share in a bit, another way where you can still access franking credits and not get taxed at 30%, or we just accept the new economics of it, which obviously most people won't want to, and we're just not going to send any money to bucket companies anymore. So if FY29 onwards, distributing to a bucket company is still in the structure, it becomes totally counterproductive if we have this 30% tax. The simple bit of it is you're not getting offset for the tax that the trust, which is this new thing. This trust is getting taxed. We've never had this before. The trust is getting taxed, and then you're going to get taxed again. That's just, again, bonkers, in our opinion. So a bit complicated one, but we'll run through some strategies after this as well to kind of break it down for you. What could we do to try to manage that new change?
Yeah, cool. Hey, just a quick note as well. I'm seeing in the chat box there's a few questions that we've actually got covered in later slides, particularly around examples of CGT or residential versus commercial property. So yeah, we've got a fair bit of content to get through, but that's definitely all on our radar. So we'll keep on getting it through. So yeah, I might run with this one. So what do we do if we can't use bucket companies? Well, it seems like the government are pushing everyone away from trusts, or at least trusts at the top end where we run our businesses from, and pushing it into companies. And that's clear or supported by the fact that they're giving us concessions or rollover concessions when it comes to restructuring as well. So instead of, let's say, having a trust that distributes to a corporate beneficiary, which we now understand.
Starts in 20.
We've got bloody notifications popping up, but that will result in over 50% tax from our understanding. We're looking at a ideal structure going forward, and we've got a trading company which is owned 100% or whatever. Obviously, if you've got more than one shareholder, it might not look exactly like this. But you've got a holding company. Now, the benefit of this holding company is the trading company is taxed at 25 cents in the dollar, and assuming the certain conditions are met, which is quite straightforward, the holding company should inherit that 25% rate. Now, our understanding of this is for family groups where you're looking to invest money at a lower tax rate like 25%, we're going to start keeping the retained earnings in this holding co and either investing directly in there or lending the money from the hold co to another company because there's no Division 7A issues in that transaction. So we're going to lend it over to another investment co, and that's going to do the investing with a net 25% tax rate. If we pay a dividend through that discretionary trust under this structure, we're going to pay a 5% top-up tax in the discretionary trust name, and then you'll get taxed on the individuals will get taxed on whatever their marginal tax rate is, less that 30% trust tax. But again, our understanding of this is we don't get to have those refundable franking credits at the individual beneficiary level, which again is like a little bit of disbelief here. So this is why I said earlier, the government a few years ago wanted to get rid of refundable franking credits. This is how you do it. This is how you do it, and not call it that. You call it trust minimum 30% tax, non-refundable. So yeah, that's the disbelief. What we understand is so far is that it doesn't impact franked dividends received directly to individual names, and it also doesn't impact SMSFs. They're excluded as well. So we can look to have refundable franking credits that way. But if it's held through a trust, unfortunately not. Um, so how does this play out? I think we've talked about examples at this high level, but
Yeah. And I think a few people are asking some questions of practical examples. So there will be some as we go through, especially with the properties and such as well. So just hold on until we get to that slide. But this is a really simple example of if there's $100 of trading profit, essentially, if the trading entity holds the shares in the trust and individual, that's where what did it say, a dollar? That shouldn't say a dollar there. Essentially what's happening is people on lower marginal tax rates are the people that are going to be taxed on that amount. So this example, if $100 was to flow through to a corporate trustee right now, $30 would essentially be taxed. So there's $70 left. If that's distributed to someone with no income at all, that $30 is not refundable. So the minimum that you pay on the income that you made in the trust is the $30. Now, because the nature is it's not refundable, that's the tax that you pay. Even though that person has no income, they're on the marginal tax rate, they're on the first bracket itself. There shouldn't be any tax payable on that. You've actually paid 30%. So the losers are actually the low income earners, where the trust distribution goes to its low income earners. The minimum they'll pay is 30% tax. Does that make sense? If you're on a higher income, you're already paying 30% in your name. Let's say I have a 135K salary in my name. I receive more distributions from a trust. I get an offset for the 30% of tax that's been paid in the trust, but then I pay the top-up tax difference, right? So that could be anywhere between 5 to 10%, depending on your marginal tax rate. So what we're seeing here is that they want to tax their income in the trust at minimum 30%. It doesn't matter what happens to the beneficiaries. It doesn't matter where the money goes. 30% will be the floor before it passes on to any beneficiaries at all. So it is quite a what stops people from being able to do previously was if you had 100,000, I could send 20,000 to 5 people with no income. There's no tax payable because there was no floor for you to be taxed on at 30% to begin with. So that 100,000 essentially becomes tax-free. Now that's a very dramatic example, but what we're seeing here is that if in a family group, ordinarily there's a little bit of income sitting with yourselves already, whether that's a salary from the business or investment income or anything else. Now, does it really impact, if we speak about our clients who already have income in their name? Probably not. Who it will impact the most is if you're distributing to let's say a retired parent, ignore S100A distribution rules right now for a second, but imagine if we distributed to a retired parent, and we were looking after them and we gave them some money to live on. That money ordinarily would be non-taxable. Sorry, no, there's no tax on that if it's less than about $20,000. Now there's a minimum of 30% tax on that. So that's, yeah, those are the people that are losing the situation here.
But even then, I'll sort of share another example of how I see this play out. So let's say you've got a family business who runs through a discretionary trust. They've got let's say they have a bad year and they only make 100 grand in that trust and for two people's effort, and they split the income 50-50. So they'd pay almost next to no tax under the old rules, but they'd be paying $30,000 between the two of them under if no change to the structure, if that's the case, under the new one. So again, it doesn't make sense to me. Again, I see old mate parade around how it's equalising the tax system. As Riz said, this doesn't impact people who are already paying an average rate of 30% or more. It impacts those who are earning less than that. So I saw a comment in the chat as well about tax reform can be good. Of course it can be, but it's got to make sense to be good. So again, that's the struggle we're having with a few of these rules. And
Matt actually has a good point in the chat, Ben. If you employ all your beneficiaries and they're paid over 45K, 30% marginal tax rate, are you largely unaffected except to 2%? That's spot on. That's absolutely spot on, man. And that's one of the things that we're going to be looking at more is if you have a family business and you have family members and if they work in the family business and you trade through a trust, the beneficiary distribution is not going to make as much sense as a salary, but there are other considerations, things like super, Medicare levy, and even payroll tax.
Payroll tax. Let's imagine that business I talked about where they only made 100 grand. Let's say that they're a significantly large business. They're already in payroll tax territory, so they go and pay themselves 50 grand each. Obviously, super needs to be paid, and you've got whatever percent payroll tax on top of that. So
yeah. Los Angeles chicks, my neck's gonna hurt by the end of this.
All right. So we're already trying to work out, well, how do we do tax planning now versus doing tax planning in 2029? So again, I think all we've done here, Riz and I were chatting this morning for a fair bit. We're trying to work out like what do you think? What do we think our moves are going to be when we're advising clients? So here's what we think. Again, there's years between now and then.
And I'm going to preface that as well, Ben. Like we've had, just over 15 hours just to kind of go through this, minus sleep time as well. We're trying our best here to react pivot for our clients and also for people who are interested to learn more is to go and, well, what can we do in 2 years time? So it feels like we need to do everything today, but what I spoke to Ben as well is most likely we'll have a part 2 of our webinar as well, where things are going to settle a bit more. We're going to hear more from other advisors that we work with as well. And even our internal team, like we're quite disjointed in terms of like how we would do things right now, because it's kind of like a bombs drop and everyone's trying to figure it out. But we feel like at least today, I want people to start thinking from a different lens. The thing that I want to encourage people to do is like, okay, things are changing. What's my structure like? Yes, I've got time. I need to start thinking about that. Do I have properties and investments that I need to think of what's going to happen to that? So today's webinar is more of that and some ideas that, again, we'll polish up in part 2 as we get into the thick of it. So I'd love for you guys to start moving those cogs in your heads about your business structures and personal wealth as well.
Beautiful. All right. So in a sense, where our minds are at is a current thought process around tax planning, particularly where you've got trust income, is that we want to spread income around the family group, obviously meeting all the tax laws to pay the least amount of tax possible. Well, if we've moving forward from 2029 financial year, our thought process will be, well, we've already paid 30% in the trust. So we're looking at, instead of let's say an ideal personal income of around 135K, it might be looking like about 180K up to 200 per individual in our mind, because the average rate of tax will sit at about 30%. And what we don't want to do is have clients pay this 30% minimum trust income and not be able to offset, have enough income to offset the effect of that. Obviously, if there's other ways to, sorry, I am still alive. If there is other ways to get income in the name without paying that 30%, as we discussed with the salary option. I mean, that's another way that we can, look to get a similar outcome.
Yeah.
Uh,
And I think it's important to address that. If we think about the trust as being this uh, gate that income is flowing through right now, whether you have a trading entity in a trust or you have a trust holding shares in bucket companies and companies the like, or whether it's trading entity or investment companies, it's always been this gate where money passes through, right? Before there was no tax, you just distribute to that to the beneficiary. Now there's a tax. Now we need to think, how does that impact everyone? Where some of it still makes sense for us to flow through, like, in Matt's situation of, you're already at 30%, doesn't matter. Where it doesn't make sense is we're less than that. But the other part of it is franking credits also flow through this gate. Quite often you pass it through this gate and essentially you get it, but it also flows through to the beneficiaries as well. What we're reading is right now is that that's just going to be chewed up in the trust. Once the trust has taxed and eaten up that franking credit, it doesn't flow through to the beneficiary. So again, we need to think of that as the possible scenario happening, and how do we make sure that it doesn't flow through the trust. Now, that's why we talked about restructures as being one of the things that we need to focus on as well. Is if we're structured in such a manner that there's that rollover, that we're hoping, we don't have any details on that yet, but we're hoping for some of that stuff to come up as a bit of an amnesty for us to get our house in order, to not be significantly disadvantaged, because the purpose wasn't to be taxed at 30% to pass through. It was to benefit our whole family as we make income in all these other entities. So this is kind of the interim version of, all right, cool, how do we preserve the franking credit as it flows through this gate so that it doesn't disappear? So that the headline there of protecting refundability is by looking at how do we can still keep that franking credit being refunded. One of the ways is to possibly own it personally, your shares directly in your business personally. There's things that you give up with that, of course. That's what you see on the left and right hand side there, what you keep and what you give up. Obviously, if you own things in your first name as a business owner, director, asset protection becomes weaker versus through a trust. So again, there's going to be some strings that we pull on one side, it's going to impact the other. It's just which one's our priority is going to what we're going to be thinking of as well. Now, but the difference is that you get to keep that franking credits, right? So point number one on the what you keep, refundable franking credits, when you pay dividends, you get to keep that. Obviously, you give up the flexibility of being able to distribute that across. The other one here is 25% company tax rate on profits. This is if we are using what we call a holding company, which is what we saw before previously. Holding that in a holding company instead of directly through a trust, we still get to keep that 25% company tax rate. But it'll be very hard for us to vary those distributions in a low income year. We're trying to get that money out. There will still be that 30% gate that's going to bite into that profit that we're trying to extract before we get to our family members, if there's a trust involved, or if it's held directly as individuals. It's hard for us to vary that, unlike a trust where we can distribute that differently per year, because it's more hard coded when you have whole shares personally as well. There's a few things like that we need to consider as we go along, but the refundability is kind of where Ben and I's discussion, we went, it's like, oh, if non-refundable is kind of the big issue with the 30% tax rate, of course, is one of the big issues with from a company. How do we protect that refundability against the changes that we have now?
Mm. We've got some other ideas that we brewed up this morning, but again, they need to be tested against broader tax minimisation and evasion rules. But, and I think that's the sort of stuff that'll come over the next few weeks and months as this stuff becomes a bit clearer, is exactly how we play our cards. Because at the moment, it just seems like it matters how you've got your structure set up to the difference of tax you pay, and that's always been the case to some degree. But this seems almost unnecessarily complex. But
Mm.
we'll,
And maybe if I just kind of interject a little bit, I feel like a lot of people were focusing on the property stuff, and then when I looked at it, we went, well, the property stuff is almost easy to deal with because we know what the known factors are. It's this trust thing that's a little bit of a red herring for us, because we went, wait a minute, trust 30% tax? What? The trust is central to a lot of our client structures, right? How does that impact in every situation that we have? that's where we were running some of these ideas in this last, what would be 10 hours or so. And we're going, wow, okay, it's actually, the hole's actually deeper there. So there's a lot more that we need to unpack. That's why we're kind of leading with this a little bit, and might fry some people's brains where, wait, I came here to talk about my properties, and I thought that was a big thing. I find that this site needs to be looked at quite a bit too, because there's a lot that can happen, and you might get caught out by not getting that advice around the trust side of things, especially if you're a business owner that has shares and investments held in one.
Awesome. And just on the CGT side of things, so one of the things that we were talking about this morning was the impact of capital gains and how it impacts the other stuff. So, sorry, the other income in your own name. So the rules are written. So now there's a 30% tax on gains at minimum, and this is what I understand to be taxed in the individual name, for instance. The other things to think about, and we've had clients caught out on this, is even in the last couple of years where they've gone to sell a property and all of a sudden they've lost or massively reduced their client childcare subsidy or other government benefits like family tax A, Part B, parental leave pay, all that sort of stuff, because they made a significant gain. So what we could have is cascading increases here. We've lost the CGT discount from a certain date onwards. We've got this 30% minimum. We could lose government things in the year that we sell the asset. And so our thoughts is we might see a fair bit of behavior change when it comes to the idea of selling a property because of the downsides of these extra taxes now. One way to access equity in a property is obviously to sell it, but another way is to go to a bank, redraw the equity that's been created with no tax effect on that. Obviously, you pay interest on it, but that is maybe the behavior. So we might see people hold and retain properties a lot longer because of the tax impact as a result.
Yeah. And the thing about this one that catches people out a little bit is, again, it's like, what's the other things that get impacted when you change? When we submit our tax return, what we're actually telling the government is, here's our taxable income. What they actually use that information for is the income test for all this other stuff, right? How much childcare you get and all this stuff. When you change something up the line in the formula, right, which is a percentage discount on capital gains, usually it's 50%. That's what you would have been. If that's changed to, not 50%, the cost base was the cost base at the time with indexation and the 50% discount and the minimum 30% tax coming into play. What can happen is that your capital gains that gets reported in your tax return gets added into your marginal tax rate, taxable income to then be marginally taxed, increases, right? So obviously we know that was what they're trying to do, is increase taxes, but that is also used to test all this other stuff. So we need to be mindful of that when we have a gain happening, we really need to look at the impact across all this other stuff as well. If you're planning to have a child with with your wife, for instance, and you have parental leave coming up, and you want to make sure that you're eligible for that. If you had a big capital gain last year, because it's tested on last financial year, you might not get that parental leave pay. So again, considerations are a little bit more than just how much tax do I pay on selling the property. We need to look at how that impacts all that other stuff as well.
And I know that the slides were slightly out of order there, but just wrapping up the last slide I've got on the trust tax changes, the 30%. Our current understanding is that unit trusts are excluded from this because that fixed trusts are apparently excluded from this 30% minimum. So we do have clients that are structured as a unit trust. And again, I think the conversation or the scenario that we're going to play out with those clients is going to be slightly different, obviously. But in my opinion, there's no immediate change required from a unit trust to a company because we don't have this 30%. But what we do need to consider is who owns those units in the trust. That's really the key that we need to work through with unit trusts. Cool. All right, so now we'll switch back into capital gains. And again, the primary change is the removal of the 50% CGT discount. It is being replaced with a method that was available years and years ago, which was the indexation method. And it depends on when you purchased your your asset that you're disposing of, which one will apply. And in some instances, both are going to apply. You'll get a 50% discount on anything purchased before, well, really, it's before 1 July 2026, before these changes come into effect, because you'd had to own the asset for more than 12 months anyway. So it looks like we can still get the 50% discount on the gain made up until 13 months away. And what that means is we're looking at, like, the practical application of that is we need to go and get valuations on property we own. Shares, market listed shares are going to be easy. Units in unit trusts, easy if they're market listed. But the tricky ones are going to be property, where you need a valuation up to the point where this changes. And same for businesses. Like if you own a business, it'd be a smart thing to get a valuation done as at 1 July 2027, so you can treat the gain up until that point. If the entity you've got is entitled to the 50% discount, generally, then you'll want to make sure that you've got some form of way of documenting the market value as at that date. Um, so yeah, that's pretty significant, and that's one of the ones that was leaked pre-budget. Now, a couple of important things, or things that were unchanged. There's no change to the main residence exemption, thank goodness. Who knows if that'll be on the cards at a later date. Also, the small business CGT concessions. So the 15-year rule, the full exemption, that stayed. Active asset test, retirement exemption, and roller or replacement asset test, they're all untouched. But often what we did with small business concessions is it interacted with the 50% CGT discount. So what we're thinking with clients, we've got clients that we've done restructures for, and we may even do restructures between now and 30 June next year, because we can still access not only the CGT concessions, but also we can access this 50% general discount on top. So again, the message I want to share is, it's not just let's sit and wait until 1 July next year, because it may make sense to restructure before that date so that we can access the 50% general. The super fund CGT discount, I was wondering what they were going to do with that. Instead of being 50% discount, super funds get 1/3 discount, or 33%, for assets held more than 12 months. And then companies, they never had the CGT discount anyway, but they do have generally a lower tax rate. It's a flat tax rate of either 30 or 25%. So I'm also unsure. I can't remember whether there's indexation, probably not available for companies. Yeah, that's one that we probably need to confirm. The budget surprise is, so capital gains tax in Australia came in 1985. I think it was in September. The date, I thought it would be more burned in my brain than that. But what that meant is that if you own shares or property or all sorts of stuff pre 1985, and you sold it later, then you'd pay no CGT, because capital gains tax came in after you bought that asset. Now, what's happening with pre-CGT assets, and it's pretty uncommon now. Like I think the last one I saw was a few years ago. But pre-CGT assets get their tax-free, their CGT-free status on the purchase price to the market value as at 1 July 2027, and then from that point onwards, we deal with the asset. Like if you sell it 5 years after that date for another $1 million, we'll have to look at the difference between that market value at 1 July 2027 and when you eventually sell it. So it will no longer be completely CGT free. I wonder if they'll take the loss if it comes down in market value.
Yeah, and I think it's important to kind of address this from a scenario perspective. If you have a property right now, if you sold it before 14 months time, so July 2027 here, you still have that 50% CGT discount. That's provided that you purchase that as well before that period. Obviously, you have it already now. But if you, let's say, purchased it before but sold after 1 July 27, that could be any time between now and 2027 that you purchase that. There is a split treatment, because there's a point in time where you were on the all 50% discount CGT concession, and then gains post 1 July, they're using the indexation and 30% minimum tax. Now, if you purchase it after 1 July, you're just on the new rules, and you sold it, because obviously you'll sell it after 1 July as well, on the new rules. I just want to put a bit of I don't think we have a super practical, not with property, but Something that I just want to add in there is that 30% minimum tax and the indexation, how does that actually work? Now, what the indexation works by looking at the inflation over those years. And usually it's a cumulative effect of inflation over those years. What they're trying to do is say your cost base, which is what you deduct. Now, if you buy a property for 500,000, you sold it for a million, your 500,000 is the cost base. Now, your capital gain will be 500,000. In the current rules, you would take a million minus 500,000, then you have 500,000 gain. You get a 50% discount on that capital gain. So 250 is then added to your taxable income to be taxed. In the new rules, what's happening is actually the 500,000 cost base actually moves with indexation. So it's not locked in at a certain point. You use indexation as a way to increase the cost base, i.e., inflation increases the cost base of your property. Now, at the same time, you might sell it for $1 million, but your cost base is going to be higher. So you could have a lesser capital gain, but the discount is not 50% anymore. You see, that's just going to be your gain. That gets added to your taxable income. And then the 30% tax is a floor. It's not a tax on that gain. It's a floor. So at minimum, you're going to get taxed 30% on any gain that's made there, or you get taxed on your marginal tax rate. That could be up to 45%. So it's important to understand that there's no different discount. I've heard misconceptions are like, oh, the discount's going down to 30% because they mix those numbers. Like, no, there's no more discount. There's just no more discount. You're going to get taxed on the gain. What they're moving to help you is to move the cost base up, and then that's your gain. Now, what percentage of that is that's kind of irrelevant is your gain's going to be. And I did some numbers on my own property, and I went, it's more based on inflation in the last few years. It's going to be more tax that you're going to pay on that, because the discount is a straight 50% discount on any gain that you made. So that, again, modeling those numbers are going to be important, even if you don't sell it. Like, we got time before you want to do anything, but modeling all of that will be a good exercise to do on your actual numbers to be able to understand, okay, cool, this is actually the new tax bill that I'll have to pay. Especially if you own it now, that property, it'll be a split treatment up to 1st of July. It'll be on that 50% discount. Any gains made from 1st of July onwards is on that new indexation. So that's why it's so important on that 1st of July 2027, you get a valuation of your property, because they're going to calculate the gain from July 27 onwards on the new regime based on that cost base of valuation that you do at 1 July 27. So I hope that's really clear in terms of, like, as practical as an example we have right now, but running those numbers will be really, really important.
Awesome. Alrighty, we are tight for time, really, so we might have to run through the rest of
So
the
done
stuff.
this 2 hours.
Yeah, I do want to give a couple of examples, because one of the things I'm concerned about is business owners. So often when we start a business, we have very little to no cost base, and in this instance, we might have a $10 company, and I wanted to look at the modeling of, well, what if we hold that for 10 years and sell it for $1 million? This is without small business CGT concessions, so that might massively further reduce your tax. But let's imagine we don't get that, then that $10 that turns into $1 million, under the old rules, because 50% CGT discount, we might look at about 234K or 235. Under these new rules, indexation, when we're only indexing $10, then we're looking at massive, like, that's almost twice the tax under these rules. It's incredible. And again, I sort of feel that the biggest losers in this budget are family small business. But that's how it feels. I mean, I know I'm biased because I am that, and that's our market. But, like, try to convince me any other way. That's a huge percent. If we have a look at an investment property bought in 2015 for 320K, it's worth $500,000 at that transition date, the 1st July, sold a few years later for 800. There's obviously two different methods we need to calculate, but the tax under the old rules would have been 112. Tax under the new, again, we're looking at like almost 50% extra tax under these rules compared to the old ones. So it's not like it's an extra couple of percent or a little bit extra. It's like massive. These are significant differences. What if we invest 100 grand in a share portfolio in 2020? Now it's 180K at 1 July, and we sell it a few years later for 250. Again, not as crazy, but 25, 30%. We should have done the percents as well here. But it still is, significant in the additional tax under these new rules. It's
And I just want to point out one thing, right? Like in this situation here at the top, you'll see that it's 40, we've assumed a 47% marginal tax rate just to make the calculations easy, and a 2.5% inflation. Inflation is going up, so that might move your cost base a bit more. If it's under control, cool. We can't predict that. That's the other thing that's annoying about this. It's hard to actually figure out what to do with your when to sell, how much tax. The calculation's a bit more nuanced. But that 47% marginal tax rate means that we're above, in this example, we're above the 30% bracket, right? That minimum 30% tax on capital gains. Now, in a situation where, let's just imagine a really simple scenario. I'm a small time investor. I invested 5,000. I made 10,000. It's 10,000 now. It's worth 5,000 more. I know it's a stupid example. I don't have any other income. That's my only income. In the normal rules right now, I wouldn't get taxed on that capital gain because it's below the 20,000 tax-free threshold. Because it's a capital gain, they've kind of carved that out and said, no, there's a minimum 30% tax on that gain. So that's what this example is not showing as well, is you get taxed even if it's not to do with your marginal tax rate. It's a minimum 30% tax on that capital gain that you make across those assets. So I just want to point that out. There's a difference there as well. And Kelvin, nice seeing you here as well. Yeah, it's not just property. It's from what we're reading right now. It's capital gains assets. So gold, silver, in trust and personal names. Yes. So capital gains. It's kind of the big umbrella. What capital gains you make. That's the changes here.
awesome. So yeah, I mentioned it in the previous slide. Hey, Kel.
Kelvin, sorry, it's funny.
Are you considering staying in Switzerland, Kelvin?
You might stay there in Switzerland.
But yeah, so we mentioned that the valuations are really critical. They are if you intend to hold the asset past 1 July. Our suggestion is for illiquid assets or assets that you can't go and look up their price at 30 June. You may require a formal valuation there. So there's lots of and the market here is probably going to go a bit crazy. We already work with some people who do valuations for property, and they can even go and retrospectively do them in certain circumstances. But that's one suggestion that we'll have for clients who want to hold their rentals a bit longer. And then the other thing as well is for businesses, Inspire can help with a valuation, for instance. If you want to lock in or work out what your market valuation is going to be as at that 1 July date to make the most of having that 50% discount available.
And the valuation, just want to explain that practically, right? Like, why do we want to do a valuation there? It's because the gain, if we think about pre 1 July 27, we've got this, I would have thought normal. Now I'm thinking generous 50% discount. But before 1 July 27, it's this 50% discount. We love it. We want it. We want to keep it, right? Up to that point, any gain from that point onwards, we've got this new indexation method where there's no discount. It's indexation of cost base and minimum 30%. If we do a valuation at that point, if it's again, not in our control, but if it's a high valuation here, what it means is the gain that you have from this point starts at a higher bracket. So what it means is it needs to grow quite significantly first. So depending on how the growth from that point is. So if you don't have that valuation, you have to use this method 2, apportionment formula. And look, it might be cheaper, but it might not be as exact as actual market value at 1st of July 27. So that's a key date. If you don't have that in your calendar, put it in your calendar, not on the 1st of July, please, earlier, so that you have some thoughts around what you need to do with all your assets on the 1st of July. Because again, I say all assets, not just properties, it's your business, your shit, because it's valuation on that date, because the regime is changing from that point.
Cool. So negative gearing was another big thing in the budget. I don't really think it's a big thing because, and I've seen some questions around commercial property. So negative gearing with commercial property, you're still okay. Shares and margin lending, if you're doing that, we can still have a tax loss running against that. New builds for residential, we're fine. Even if we own a current residential property, and you sign the contract before budget night at 7:30, you are grandfathered. If you're signing a contract for established property any time from now onwards, and it makes a tax loss on its own, then we can't offset that against other income from 1 July 2027. I think they put that forward date on it so that there's not a big flood to market of people who rely on negative gearing to repay their loans. So yeah, that's again a nice thing. But again, I just see what's the point of this when and yeah, they might say, oh, it just pushes money towards new builds. But at the end of the day, I just feel like established residential didn't really get much tax benefits anyway. They're often not as negative geared as new builds anyway. So who knows? I don't. It's just another thing I don't understand. SMSFs and widely held trusts excluded as well. We don't see this too often, but you can get negative geared property because you can loan money in super under the right structure, and it'll reduce your 15% contributions tax or other contributions tax if you are in accumulation mode. But we do see an exclusion here for negative gearing and super funds as well. So. Um, yeah, anyway, that is interesting. Now, two paths to restructure. So we're talking about, well, if you've got trusts and companies and they're probably not an ideal format right now, we sort of see there's two main ways to play this, and it will very much be dependent on your current situation. The path B, I'll start with that because that's what's been suggested in the budget, that we all wait to this rollover relief and we roll it over into a new structure from one of those dates, and then we're off and running. But my suggestion is restructures can be fantastic for a number of reasons already right now. And because we have the 50% CGT concession up until 30 June 2027, so for another 13 and a half months, it might actually make sense to restructure before then and not rely on those rollovers. Now, we've done dozens of these at Inspire. We often see, massive tax savings. We optimize a business structure in the process. And so again, I think, what our plan is at Inspire, again, we've had hours to think about this, is we're going to be reviewing every single client structure to make sure we work out which pathway's the best for them, whether it's path A or path B. And obviously there's time sensitivity around it. If it's path A, there still is considerations around timing with path B. But in any case, I think we've got our work cut out for us in the next 13 months when it comes to making sure our clients are in the optimized structure for them from when these things kick in. And I guess the message we wanted to share is don't assume to wait till 1 July 2027 because it may actually be way better for you to restructure now rather than later under the current rules. So what do we know about the 3-year rollover window, Riz?
So in the 3 years that we have, again, the restructures that come to play here, we cover income tax, CGT relief on restructure. So that's a federal only. Ideally, what we're going to be kind of walking away from a little bit is the discretionary trust, RIP, but using it in a way that it's attached to a holding company that we shared first to begin with. Now, when we do that, we're looking to use the existing, there's all these letters in here, but there's existing rollovers right now and small business CGT concessions that Ben mentioned hasn't been touched, other than we pair that with the 50% CGT discount. But again, we have that until 1st of July 2027. Now, what it doesn't cover in the 3-year rollover window is what's going to happen with state stamp duty. Now, usually whenever you transfer businesses or properties or assets, there's some sort of stamp duty that comes into play. This is where we're kind of watching a little bit because they will release their own budget. Stamp duty is a bit of a pain in the bum, but for instance, positions as of right now, Queensland small business restructure exemptions, if you move from a discretionary trust to a company, not a fixed unit trust, and you have a $10 million asset cap and less than $5 million in turnover, there is an exemption on stamp duty there. Now, each state's going to be different. I'm not going to go through each one of them just in interest of time, but this is what we want to watch out for is at the federal level, we might not be hit by a tax bill for restructuring our group with their rollover relief, but we might be hit by state taxes. So we just need to watch out there. That's separate, obviously, separate powers that we have. It's not in the budget. That's not covered. So,
And The
So
other thing that might happen is because of this massive change, we may see stamp duty or the different states create their own rules around restructuring here. There's a few rules already that exist in some states. Some have stamp duty on business sales, some don't. There's all sorts of different rules. But again, just given the given the significance of all of this, and Calvin, I can see your question there about what about stamp duty? Exactly our thoughts as well when we're looking at restructuring. We don't quite know yet. I don't think the states are compelled to do anything, but let's hope that they help out somewhat. Again, given the significance here. Oh, goodness me, Riz. Testamentary trusts.
yeah,
So again, this goes back to the 30% trust tax, um, which is pretty significant. Again, I sort of hinted towards that this is death taxes without calling it death taxes. But where we've got testamentary trusts, and just they're based on the will that someone has when they die, and there's essentially a testamentary trust that's created on death. Now, how it is a type of trust. There are tax benefits, particularly distributing to young children under 18. But what we're seeing here is this 30% thing will apply to testamentary trusts, apart from if it's fixed testamentary. So again, I don't know enough about how that operates to advise right now. But it may mean that we need to work out what percentages we're going to give each beneficiary right now, and give them a fixed entitlement to a testamentary trust. Whereas my understanding of testamentary trust generally was we'd have the discretion every year of who ends up with the income of that trust. So it might turn from discretionary to fixed now. And again, I don't even know how we account for unborn children at that stage. Who knows? So again, something that needs to be on our minds is, do we need to update our estate planning as a result? Um, all right.
so
Mm.
when we look at the investments that we have, there's kind of two paths from now. If we think about two likely scenarios, I'm not talking about every scenario right now, but if you have a trading company, and we have a holding company now, that's been restructured into, that's probably the best place for you to hold your wealth now, for you to transfer the risk, the retained earnings in one company to a trading company to a non-trading entity. Now, in that non-trading entity is where you would invest all your money, whether that's in property shares. What happens now is that it ring fences the trading risk from accumulated wealth. So Holdco doesn't trade at all, but we have one entity, one tax return. The cons to that is, if we distribute all the income to this holding co, once the passive income exceeds and then we invest that money, once that passive income exceeds 80% of the total income in that company, the company tax rate actually steps from 25% to 30%. Before that, it's the same as your trading entity, 25%. You also have less flexibility to segment investments by risk type as well, where in the past we would do this in the trust, and essentially invest in the trust, but that 30% tax is just not making sense, especially when it's not refundable. Whereas in this situation, the returns and the tax that we pay in that will still be sitting there as franking credits. Option B is, we have the whole co, and we can move the money across to another company, another investment company, and that's by way of a loan, and essentially invest in a separate investment co as well. So again, it ring fences the trading risk and investment specific risk. So that's the difference there. So if you have certain investments that you didn't want to taint another investment due to that risk, you have separate investment codes set up and lend the money across those companies. Again, it maintains that 25% rate on trading profits in Holdco, but not in those investment codes, because the income will be mostly passive income. So 30% tax rate goes in there. A bit more headache. You got companies to administer an investment co pays 30%, like I mentioned before. Yeah, so a bit of changes in how we think about where are we going to invest our money, in what structure, not asset class, in what structure. That's going to have, you're going to have a relook at that. Your previous knowledge needs to take into account this change that's coming up in 2 years' time.
Alrighty. And just running through, I think some of these were mentioned earlier as well under the sub points, but thank goodness a few things didn't change. We got no change to small business concessions, no change to main residence exemption, superfund CGT discount stays as is. Existing residential property negative gearing won't change. Companies and the 25% tax rate. Again, I'm just confused on why we've now got 25% anymore. Why didn't they just get rid of base rate entity status like the 25% while they're at it? Just make our lives even more interesting. Division 296, it says it's unchanged. It's unchanged from the budget, although it kicks in a month and a half. Same thing with Payday Super. Not a budget announcement, but a significant change that we've had coming up. I think that was a release a couple of budgets ago. And then it was a budget announcement, although it's continuing a threshold that's the same, which is the $20,000 plus GST instant asset write-off, obviously assuming your business can claim the GST portion. That's going to continue from 1 July, and it's nice that we've got some certainty with a month and a half to go before we would have made decisions around that. So, cool. Yeah, what do we do in the next 60 days? So yeah, for people where Division 296 applies, we need to have a look at that cost base for that purpose. We've got any established resi property contracted before budget night won't be will be grandfathered for the negative gearing thing. We've got planning. We've got to do tax planning for this financial year as well. Our opinion right now is bucket companies, the strategies we use around those, they're still okay for this financial year and probably the next, I think it's up until 2028. So we've got 2 more financial years on top of this one as well. Between now and 30 June 2027, in fact, I'd probably suggest between now and early next calendar year, we need to make sure that we've got our strategy right. Are we going to restructure pre 30 June or 2027 or after? If we need to restructure at all, some clients are already in the right structure as well, or a structure that won't be impacted significantly by these changes. Review every will with a testamentary trust. Yeah, that's going to be another significant thing as well. And then, yeah, we also need to essentially, make sure we're mapping out that restructure, whether we need to do something pre 30 June 27 or after. But our message at this stage, I think we've said it 3 or 4 times now, is don't just pull the trigger or don't just sell an asset without considering how it's actually going to play out for your circumstances. And again, we've got a couple of years until that 30% trust tax comes in and also the 30% on capital gains as well. So we've got a little bit of time. Let's just absorb what's happened and then we can, through advice, work out where to go from here.
Yeah. So what's still unclear, there's a couple of things. We've combined some of this stuff with the franking credits, existing use of trust right now, where, like I said, dividends are flowing through trusts like a gate. If there's a 30% tax through that gate, will those franking credits essentially be non-refundable once it's used up? So whether Treasury will cover up fully franked dividends, we're not sure right now. Whether companies will be given access to CGT indexation. So far, what we've been talking about is the indexation of properties if it's not held in a company, and because a company doesn't get the 50% CGT discount. Current rules, we don't get that. But in the 1999 version, when they introduced the indexation, the companies actually got that cost-based indexation as well, which is interesting if we got that, because you would actually get a benefit better than what you would now, because you don't get any discount at all with the 50% right now. Whether the new restructure rollover requires no change in ultimate economic ownership. What that means is if we're moving things around in your structure, we need to make sure that ultimately it's the same people that own those assets. And this comes from a different rollover rule that we have. Whether that applies or not, we're not sure. Or can we change the ownership and still get the rollover in the restructure that we're planning to do? Trust-to-trust distributions of residential rental income. Will it be siloed? What happens to that if one has a loss and one is profitable? When a testamentary trust exists for grandfathering, when exists is the time. Is it death? Is it probate or admin completion? Still not sure. How franking credits stack through a trust chain. So if we have a few trusts that distributes from one trust to the other where franking credits flow through of them, we don't know how those franking credits will flow through at this stage with the 30% tax coming into play. Whether state term duty officers will have corresponding relief, as mentioned already, and treatment of carried interest under the new CGT regime. So whether interest that you spend on a property, let's say off the plan property for the 2 years, whether that's included in the cost base or not, we're not sure. So there's a bit that we've kind of tried to squeeze as much as possible today. Really now time for some questions. And I think if I could summarize the budget's the budget, but it's more for who it impacts. It's everyone that pays taxes, that has investments here, and business owners. That you can go political side of all of that, why, who, how, and where. I think it's more about looking at the rules of the game now. So when we think about the rules of the game, at one point, well, we had negative gearing. There's people who would have voted either way, would still use the negative gearing because it's a upper hand for them, unless you're really morally kind of stuck to your guys that you didn't use those negative gearing or you didn't want to. That's fine as well. That was a good tool for wealth creation. They're just numbers, paper, when you put the numbers in the paper, right? Right now, the situation that we have right now is there's a lot of changes coming. There's new rules essentially of the game. I think it's more about understanding how your situation applies to the rules first. More often than not, I've heard a lot of people saying, oh, it doesn't matter. A lot of the stuff I was worried about, grandfather. I've got properties, grandfather. I think the thing that the two red herrings that I just want to really bring up so that you don't just go, oh yeah, it didn't impact me, is the CGT. We want to know what that looks like because it will impact you from 1 July 27, even if you're not planning to sell immediately. And also not just from a property perspective. That's the biggest thing. If you're business owners, we need to be looking at what it would look like for your business structures as well, and business if you were to sell, because there will be future CGT if you eventually sell out of your business. And the other red herring that I want to bring up is that 30% trust tax distribution. Well, yeah, it's this gate, right? Like if that's the analogy where our wealth passed through, we need to be looking into that. How does that impact our overall net after tax income that we get? The short answer is it's going to be less because there's a gate that is going to clip at minimum 30% of the income that you receive. So restructuring through that, whether we avoid it at all, don't go through that gate, or find a more effective way to pull money out to yourselves personally, and a bit more planning each year, that's going to be important for us to address. So those are kind of initial thoughts that we have. I'm sure there'll be a part 2, Ben, and maybe more steak for you as well. But I hope everyone today had, I hope you've got some value out of today. There's some questions in here we're going to try to answer as we go along. It is well after time that we've promised. I do actually have a meeting to roll to. But for those of you who did join us today, thank you so much. There's going to be more updates as we go through. Get in touch with us. If it's very specific, you've got very specific questions, this is the time to start talking to your accountants. Again, not to panic, but just to make sense of what the new rules of the game look like from now.
Yeah, awesome. Just also to mention, there's been a few people ask, is it going to be recorded? Yes, we have been recording. We'll release the recording. It should be later today to everyone who's registered. What's funny? What do we?
Kelly saying good night because he's in Switzerland.
Yes.
Thanks, Kelly.
Cool. And yeah, if you are working with us as a client right now, we'll be working out like when the rules become clearer, and we might even wait until there's the discussion happening within the government, and they're very likely to be enacted into Parliament. Around that stage is where we're going to be reaching out to our clients to work through what your structure looks like now versus any recommendations or any changes we'd suggest over the next couple of years. So that's our goal. If you're not currently working with us, the next step we'd suggest is a strategy call. And I think that, so one of our team, JB, has just posted the link in the chat box if you do want to have a chat with one of our accountants. Again, I wouldn't if it's just about this budget. I think we might need a couple of weeks to to see where it lands. But the next step, when we're doing structure reviews, is a structure and strategy session where we'll be rolling out some advice around this. So just keep that in mind. Um, Awesome. All right. Well, yeah, I'm not really seeing many other questions in the chat box, apart from some thanks to us. So yeah, really appreciate it, everyone who's joined. Hey, George, good to see you here, mate. I'll see you in a couple of months, actually. Heading up your way.
Thanks, Amanda. Thanks for joining as well. Nick, Mark, thanks everyone. Melissa, thanks for saying thanks as well. Appreciate it. It takes a lot to put this stuff together, and I appreciate you guys joining us today. And I want to thank the team as well for setting this around. In the morning, scrambling across it and making sure we try to get the best presentation that we can get so far. But yeah, look out for more information from us part 2 or get in touch.
You've
Thanks,
done
Brett.
very well in a very short period of time. Thanks, guys.
Thanks. Thank you. Thanks, guys.
Thanks very much. Good to see you, Daniel. Thanks, Heidi. Yeah, we did this morning. Oh, yeah. I opened up my phone to see some of the announcements and I was like, not tonight. Bang.
Yeah.
Oh, dear. Yes, wild outcome. But anyway, we will see.
Thanks, guys.
You got to run, boss.
Yeah, I gotta go. Bye.
Thank you.
All right. Thanks, everyone.